Selamat, selamat apa? Selamat pagi. Ini semangat nih. Ya. Pagi terus tiap hari. Ya, kemarin sudah masalah UJK. Ya, dan next untuk today sore ini adalah insurance market. Teman-teman semua, saya ingin mengingatkan bahwa pertemuan kita itu sepanjang pendidikan ini kalau nggak salah ada 21 atau 26 ya. Nah, di sini kita kelas ini ada 49. Saya ini orang udah senior semua ya, tapi tetap saya ingin menyarankan ya, akan lebih baik kita bikin grup. Artinya gini, bahwa ini ada modul ini misalnya kalau ini diuji ya, itu kita satu grup ini bikin summary deh. Kita share. Jadi kita belajarnya dari sekarang. Paham maksud saya? Ya, jadi kita mulai belajar dari sekarang. Kalau numpuk kita udah tua semua, bukan tua, saya yang tua. Saya yang tua itu ngingetnya susah. Oke, jadi kita ada mata pelajaran yang nanti kita akan uji. Nah, daripada belajarnya ditumpuk nanti, nah ini kita bikin kelompok ya. Nanti kelompok misalnya satu kelompok 8 orang misalnya ya. Nah, 8 kelompok ini bikin summary untuk mata pelajaran hari misalnya. Oke, summary itu di-share di grup. Ya, jadi kita semua belajarnya bareng. Ya, saya ingin teman-teman buat teman-teman yang kita grup 1 misalnya, belum bikin summary, kita berdua rame-rame. Biar bikin ya. Begitu seterusnya sehingga kita kompak nih. Saya ingin CIIB kali ini lulus semua. Amin ya. Saya ingin lulus semua. Saya nggak ingin, saya capek Pak sebagai pengurus ya. Kalau nggak lulus itu apa salah kita? Apa salahnya? Saya sudah membawa katakanlah Pak Ridzuan yang senior, yang udah kenal semuanya dan pengalamannya baik ya. Ini yang kita share. Sehingga kalau itu nggak terserap, salahnya di mana? Nah, pengalaman kita memang melihat bahwa kekompakan kelas itu membantu. Saya nggak ingin teman-teman pada jaim di antara teman-teman. Jaga image, malu ini, jangan. Kita kelas di sini itu teman, di luar boleh berantem, cari bisnis. Ya. Tapi di sini kita berteman untuk sharing. Sehingga kita ada 49, nanti setelah break saya akan bagi, kemudian mata pelajaran yang nantinya diuji itu dibikin summary. Summary itu di-share di grup sehingga semuanya belajar bareng. Oh, dia belajar, oh, enak nih, tinggal ngikutin. Begitu dia grup yang lain terima lagi, gua terima. Jadi belajar semua. Oke, dan saya sekali lagi pengen teman-teman semua lulus. Setuju? Semangat. Setuju? Nah, itu dia. Let's go then. Kita Pak Ridzuan. Please Pak.
Selamat pagi. Okay, that is unfortunately the extent of the Bahasa Indonesia for my presentation. I have to apologize that this will be conducted in English. I spent 12 years in Indonesia and I still struggle with Bahasa Indonesia, but I must tell you, I also struggle in Bahasa Malaysia. My children remind me all the time, please do not speak anything but English, because unfortunately I was brought up not speaking Bahasa Malaysia. So with apologies. Right, we're going to have 3 hours of bonding time. I'll try and make it as uninteresting as possible, and we'll be asking searching questions, especially to the people I recognize, Pak Indra and my colleagues from Marsh. Okay, we'll start with insurance market, the Indonesian insurance market. You know, when we want to paint a picture of the Indonesian insurance market, the only way we can paint the picture is unfortunately through numbers. So no apologies here for loads of charts and graphs and statistics, but hopefully they can give you some context of the Indonesian market. Okay, the agenda, the insurance industry today, how it sits with other ASEAN markets, because I think it's important that we know where we stand relative to other emerging countries, and you know, and what does that mean for the future. And then we talk about the drivers of the Indonesian insurance markets, and just my personal thoughts on the future direction of the markets. I'm sure. Tekan apa? Oh, yang ini. Oh, yang kanan. Okay. Okay, we start with the first statistic. The average. Right. By the way, I completed this, or finished formatting it at around about 3 o'clock in the morning. So there are some mistakes in the titles, as you might see. Yeah, this is the first one. Okay, to get an overview, global premium for 2018, according to Swiss Re. I use a lot of statistics because they are very comprehensive and paints a fantastic picture. So 5 trillion is the number. First time it exceeded the 5 trillion mark. Emerging markets is actually a most important element of the growth of the industry, and in that sense, Indonesia is one of the countries. The breakdown between the massive life premiums and the non-life premiums, and the split between the various classes. So that's the global view of it. Then when it comes to the personal spending, right? Average per capita spending in the advanced markets, in Europe and the advanced Asian countries, $3,700 per person, per capita. And then when you look down to emerging markets, it goes right down to $169 per person. There'll be more statistics in the following slides in terms of the breakdown of this. But again, that you just get an idea as to how much money we are spending right now compared to what we should be spending, compared to what other countries are spending. But when we talk about the numbers that we look at to compare, we talk about percentages of GDP. We talk about insurance penetration. I mean, that's the only measure that we have right now. So I think it's important for us to also get a sense as to when we talk about GDP and population, where we are in Indonesia. So, for example, if you look at the as you will see in the following slides, you'll find that Malaysia and Indonesian production levels are about similar, right? But if you look at it, you look at the, you know, where Malaysia is in terms of their GDP and Indonesia's GDP. I mean, you know, Indonesia is 3 times the size of Malaysia. So in that sense, the potential is all there. Malaysia is in a different phase. So, you know, these numbers and rankings that you see, we need to kind of bear that in mind. So, Indonesia, you know, $1,000 billion GDP compared to Malaysia, 300. Thailand is at 500. Vietnam is 260, and Philippines is 360. But then if you look at the population, again, we all know Indonesia is at 267. Thailand's at just under 70. Malaysia is at 30 odd. Vietnam is 95 million. And Philippines is at 108. You can see that actually there are common links between Philippines and Indonesia in terms of population growth and in terms of, in fact, the NatCat issues as well. So total premium, we saw that 5 trillion number. This is now I've selected those specific. Sorry, something just to backtrack. Those countries that I identified in terms of benchmarking with Indonesia, I specifically identified them as part of the emerging ASEAN countries. There's no point, you know, if you want to include ASEAN, there's no point including Brunei. There's no point including Singapore, because those will only distort the kind of image that we want to see. So I've purposely chosen these countries because I think they're more meaningful and more relevant to compare. So this is total premium. Thailand, you know, is at rank 27, followed closely by Indonesia, Malaysia, Philippines, Vietnam, and pretty much you get this is pretty much the same order you get for all the breakdowns, and you can see the market share. This is quite an interesting number. What the total volume represents by way of share of the world market. So Thailand is about half a percent. Indonesia's at 0.4, which is coming up, which you expect within the next couple of years that number will change. Malaysia, as you can see, is just about there, but it's a much more saturated market than Indonesia, which has the growth potential. Philippines is still developing, as is Vietnam. Right. You want to see that again? Okay, this premium per capita, which, okay, you saw the overall premium per capita. This is now in terms of specific countries, how much we are spending per person. And as you can see, the reason why Cayman Islands actually surprisingly came out top. Does anyone know where are Cayman Islands and why would they be number one? Exactly. You notice that these are the two dodgy nations, Cayman Islands and Hong Kong, where you can stash away your assets. So that's why, in terms of the number of the kind of investment policies and all that being done, it's huge. So the next real country, when I say real country, the next real number would be the leading country would be Switzerland, which is spending total of under $7,000 in premium per capita, followed by Singapore. Well, island nation, and yeah, has its own features. So that's why I don't take it. Then the UK is there ahead of the USA, and then I bring in the ASEAN countries that we're benchmarking, which is, once you go to the emerging countries, the numbers drop from $4,000 or $5,000 to 500, 300. Indonesia is 76. So I hope that gives you an idea. Specifically on life, this is how it looks like. Interestingly, life is probably where the action is as far as the international insurance markets are concerned for Indonesia. If I'm not mistaken, Indonesia was probably ranked second by way of, in terms of growth potential. So you can see why. If you look at the numbers here, it's already at 15 billion, right? And it's still it's still growing, whereas Malaysia's tapped out, struggling to grow. Philippines and Vietnam again, they've got challenges to get up to speed in order to get to the middle class to be able to buy products. Non-life premiums. Indonesia is ranked 43, and you can see that's a total premiums, and 20%, 0.2% share of the global market. And then sorry. Okay, let's talk about Indonesia as an emerging country. In the reinsurance slides, there'll be some references to emerging countries and how the important role that they play in terms of global growth. But this is, what I've done is I've shown you the numbers. I've shown you the fact that Indonesia is not doing too badly in terms of progression towards more and more building the volume of premium. And that can only grow exponentially, and much of that is due to the fact that it's a strong emerging economy. So this is one particular chart which shows the attractiveness of Indonesia compared to perhaps other emerging countries. So 7 countries were reviewed: China, Brazil, India, Russia, Mexico, Turkey, Indonesia. I mean, these are all heavyweight countries. And if you look at where the challenges are, aging demographics, trade dependence, financial volatility, productivity growth, level of debt, they then map it out chart it out with each country. You will find that Indonesia does not have any current condition that pose an obstacle for growth prospects requiring action, whereas all the other countries will have at least one red. So Indonesia is all yellows and greens. So that gives you an idea as to what we can look forward to in Indonesia, given the right direction and leadership and legal framework, etc. So prospects for insurance industry remain strong. Emerging markets will power the global economy over the next 10 years. Aggregate emerging market growth will outpace that of advanced economies, and emerging Asia will lead the charge over the next 10 years. So, drilling down closer to home, this is from OJK, and you can see you can see the exponential growth for financial services across the years. It's rising very nicely. And here you can see in terms of investments, you can see that insurance constitutes a significant proportion of financial services in Indonesia. So, how is it all being taken care of? Well, this is the current snapshot as of today, more or less. The numbers might have changed slightly. 61 insurance life insurance companies, 70 odd general insurers, 7 insurers, and only 169 of us insurance brokers, not that many, and 43 reinsurance brokers, producing a total premium volume as split across there. You can see in terms of reinsurance, how much in terms of the split, how much is retained, which is in red, and 2/3 of it is reinsured out. Okay, this is the loss experience of the Indonesian insurance markets, and according to AAUI, latest 2018 numbers. And not surprisingly, property and motor will obviously take the lead, and all very healthy. You will notice that the biggest growth actually obviously is now in credit, and that growth will continue. The only thing is that we will probably find that over the next couple of years, the claims will also creep up. Any questions? Any challenge? I don't want to challenge any information or whatever. Yeah, non-life insurance experience an average growth of 9.8 in 2018. Positive growth across all classes except for marine, hull, energy, and engineering, for obvious reasons. The largest growth area was trade credit. Motor still continuing to grow because of the demand of the new vehicles. And loss ratios were slightly down on prior year. Just a quick look at the life markets. The concentration within the top of the top 5 and the top 10 life companies over the last few years. You can see that they are in a very strong position. Their product, I mean, this came from KPMG, and they're saying that basically the growth potential for life is still is there, is growing exponentially, but much of it, in terms of risk premium, it's actually not as much as the investment premium, for obvious reasons. Most of it is all investment-linked products. Indonesian reinsurance market, the 6 reinsurers. Okay, this is a repeat of the earlier slides about the breakdown of the reinsurance distribution against retained premiums. So 57.5% of the premiums actually go out overseas, go out to of the seeding companies. This is the claims, premium versus claims on reinsurance premiums, and as you can see, it makes for very healthy reading. So therefore, international reinsurers absolutely love Indonesia, and it's probably, as you can see, it's probably reflected in the fact that their overall portfolio premiums haven't really been as badly affected as some of the other markets. This is showing a selection of the percentage of sessions overseas. Vietnam retains about 70% of their premiums and cedes about 30. Thailand, about the same. Philippines, half their premiums are ceded overseas. Malaysia retains a lot more. They do about 70 odd percent retention and only cede about 22%. And Indonesia gives away 40% of their premiums. Can I ask anyone why is it that Philippines and Indonesia have very high percentages of premiums ceded overseas for reinsurance? Why would Indonesian and Philippine insurance companies not want to retain much more of that premium income domestically? Why do they feel that they have to send it out as to reinsurers? Thank you. Top of the class. Yes, because Indonesia is a natural catastrophe area. It is prudent for insurers to protect themselves and not retain too much relative to their balance sheets. So that's why Philippines and Indonesia have these higher cession rates compared to the other countries. Like Malaysia is the lowest, mainly because it's a non-nat cat area. The only catastrophic potential is flooding, but their flooding is nothing like the flooding that is seen in our country. Okay, this I had to be a bit careful about putting out these numbers, but basically, in terms of financial strength of insurance companies, a number of insurers have failed over the last 10 years and more, and solvency ratios of some insurers are still extremely volatile. In fact, in recent couple of years, there have been at least 3 companies where the solvency ratios have been a significant issue for them, where they've had their some heavy sanctions imposed on them in terms of how they're doing business. And we don't talk about the latest issue, which is obviously Jiwasraya. Over the last 10 years, 24 licenses have been revoked. Since its establishment, OJK has effectively used its powers, including revocation of licenses, and more than 4 have failed, with a huge deficit, and that number is now completely out of date compared to as a result of recent events. Whilst the industry is well capitalized, it's some insurers, including large insurance groups, are actually you can see that the solvency ratios are declining. So I mean, they just need to pump in more capital. I mean, this is not it's not the cash cow that business that it used to be. And that this chart again, it just demonstrates what we're trying to see here is the you can see the solvency ratios, like peaking. I mean, like this particular instance, it was just way off the charts, but all of them are in excess of 100 and 200 percent. So quite alarming. So it is a difficult business to navigate. So, despite all of that, Indonesia is really poised for growth. You guys are lucky because I actually broke down all these. These are all separate slides, but I've decided to put them all up there under one, purely and simply to say that look, it's poised for growth. Everything you read about Indonesia is about, yes, we're going to do a lot more business. Yes, it's the you know we're all the insurance market is poised to do to make bigger bigger gains. And sorry, I'm gonna and all the indicators are there. Like, we're a tech-savvy country. We got 140 million people all linked up. We're ready to do sell insurance to millions and millions of people. The socioeconomic grouping is ripe. The growing middle class. The socioeconomic groupings are growing exponentially. All this leads to an estimated 80 million additional Indonesians could join the consuming class by 2030. So, and then the GDP numbers speak for themselves. So, it really is a fantastic position to see for the insurers. But actually, when you think about it, right, where exactly are the opportunities for the insurance broker? Everything that all the stats and all the positive indications have been about consumer business, about tapping the markets for individual sales, whether they are householders, property policies, or motor insurance, or medical insurance, and then on the life side, where the numbers are huge and growing. Again, where does that put all of us here trying to become the professional insurance broker? So this is something that we need to think about in terms of where are the opportunities. Like Indonesia produces $4.8 billion of premium. Okay, half of it is in life, but where is it coming from? Well, I've segregated it into these three specific segments. Corporate and government. These are large companies that are exposed to a broad range of business risks. They require a comprehensive range of services to protect their assets and balance sheets. Then you've got the small businesses. They require conventionally readily available insurance products, plain vanilla, as long as it gives them the protection. And then you've got this humongous consumer market, which is the province of insurance companies and aggregators and bank assurance and all that. Doesn't help us unless we are actually putting together the schemes ourselves. So, if you look at the insurance broking landscape, well, in order to deal with it, with that business, the big stuff, the SMEs and the consumers, this is pretty much what it looks like. The complex stuff requires a high touch where we can even envisage broker involvement. Then you've got commoditized, where it's lesser than high touch, low touch. And then you've got the super commoditized, which is then no touch, and it's just done it's all automated. So as a broker, we really want to be around about here. So where are we going to get that? The global brokers, fortunately now there are less and less number of, well, I say less and less. if you think about it, you know, during my time, say, but if you look at 15, 20 years ago, there were a lot more international brokers. Nowadays, there are lesser, humongous, big insurance brokers, but purely simply because they're buying each other up. So the global brokers, they're typically known for going beyond arranging insurance and focusing on additional risk management and advisory services. I work for Marsh, and many not so many years ago, Marsh decided, oh, we're going to be risk advisors and consultants. We're going to focus on consultancy business. One of our other sort of peers, they they teamed up with a talking about Willis Towers Watson, and there is probably the dynamics of whether you're a consulting company managing an insurance broker or an insurance broker kind of harmonizing the resources of the consultancy company. So this is where global brokers actually have their strengths to be able to deliver everything, not just insurance pricing. So they provide a holistic risk advice to support the big companies, especially when there's, and it's cross borders. They will adapt by breaking out client service individuals into specialist teams. Before long, there's a cyber team expert. Before long there'll be like private equity and mergers and acquisition experts. So they're very good at evolving to understand what the client, the large client wants. Large broking houses have gone through a process of consolidation of their books towards higher premium accounts, and the ones that have gone in for the ones that have gone into consumer business, they've done so by investing big on technology. So as a commercial broker, it is prudent that we recognize that these big, bad, ugly, biggest brokers in the universe, right? We need to be operating in a different space to them. And my view is that in terms of commercial brokers have made fewer changes to their approach to client service and tend to build on strong regional or segmented schemes and franchises. What that means is that, it's still the basic client relationship that is important. Account executives continue to service clients with high level of face-to-face engagement, supported by account handler and other people supporting the account handler. There has been increased level of technology, and many firms have consolidated their SME risks to a sole insurer. So that's a no-brainer, and that to make it easier for companies to then bring bulk to the table. Speed of operational changes have been relatively slow, and where firms are successful in deploying strong account executives, a high level of client intimacy and ability to win and retain business from other types of brokers is reported. So basically what this means is that it's broking is still about relationship. It's relationship marketing, and we need to penetrate that area where these where their demand for insurance is a lot less complicated. So where do we get that business from? Based on data from Ministry of Cooperatives and SMEs, Indonesian SMEs account for 97% of domestic employment. It was an unbelievable fact when I was doing the research. And 50% of total business investment. Here's the breakdown in terms of the definitions of the size of the SMEs, whether you're micro, small, or actual SME. The market for environment is attractive, but commoditization is increasing at the bottom end. Clients will continue to value expertise and advice, but have less tolerance for the pure transactional type of service. Technology opportunities exist, but they're not fully exploited in terms of making it paperless, not without paper. And broking as a career will increasingly be built on professional risk advisory expertise. So at the end of the day, what I'm saying is that if you think about it, the SMEs, who then, these small and medium-sized enterprises, they go on to become the bigger companies, the more successful they are, and it's all about locking down those relationships. These guys are not going to be buying insurance through Tokopedia. They will need to talk to a broker, and when they do talk to the broker, that broker needs to be able to engage and deliver sound advice. And the big international, the pure global brokers, they are not very well equipped to deal with this area of business. They find it very difficult to maneuver, when they, because when they talk about, return on their investment and net operating income, these numbers to do business at this level just doesn't make sense for them as much as it does for a commercial broker. So reading off a CII research report on the future of commercial insurance broking. This is future of commercial insurance broking in the UK. Clearly, the focus is on SMEs. Now, if you read this, right, many of these elements equally apply in Indonesia. Renewed focus on SMEs, opportunity for brokers' roles to evolve to take advantage of in this sector. The global economy continues to shape the insurance market, so the platform from which brokers will deliver their services may change. In that, yes, we're going to have to deal with the fact that underwriters, we're going to make it easier for them to underwrite through systems and all that. The insurance market is ripe for technology disruption, and we talk a lot about insurtech, but quite frankly, unless we are a promoter of that particular insurtech program of itself, it's not going to be too much relevant to us. Technology-driven change in commercial insurance has so far been confined to micro and SME businesses. Growing focus on client-centric or user experience-based approach. New sources of risk data are emerging that can provide better information about clients. I mean, essentially, this report, which is addressing the UK market, which is a really mature market, which is paying significant, like $4,000 per capita. They're pretty much looking at what we're looking at. To summarize, clients seem to value their broker's role in navigating and interpreting the complexity of the insurance market, but really have little awareness of specific qualifications to do so. Clients do not see, and this is where the opportunity arises, on the whole, SME clients do not see their brokers as an advisor. They just see their brokers as transactional, delivering the price. hence there lies the opportunity to convert that relationship to be that of an advisor. What we are doing is we are protecting their balance sheets, and a lot of the time it's you know, like they're seeing us as, you know, or seeing insurance as a necessary evil, and either I deal with you as a broker because you're my friend, or I deal with an agent who's also my friend. There appears to be opportunity for brokers to shift from simply selling insurance to understanding the client's risks and provide information and business advice. In fact, if you think about it, this is exactly what the global brokers are doing. They've evolved to that point now where they are providing high-level advice about acquisitions, exposures, you know, total cost of risk, and all these big fancy buzzwords, because they understand the issues facing the big companies who have different issues compared to the growing companies. But what my point is, the issues of the growing companies are actually very similar. It's just that it's not as extensive as you know, the bigger clients. So, and this is, in my view, where the opportunities arise. And we are, you know, our industry still has the ability to influence the buyer to be able to trust us to take that risk off their balance sheets. So it ends by saying, it is therefore possible to hypothesize that the nature of the broker-client relationship is at a crossroads, with a picture of what the industry would be like in the future, somewhat in the hands of what we are doing today. So, almost in conclusion, insurance has grown rapidly in emerging markets, but there are still significant protection gaps. Risk transfer solutions play an important role in emerging market growth and development, but the value of insurance is very much underappreciated. Knowledge of how insurance works is important for making well-informed decisions and bolstering stakeholder cooperation. I mean, why would anyone want to buy a financial instrument they don't understand unless they're forced to by their bank? And we need to take this, you know, take it out of from this premise, so that they understand the value of what it is that they are purchasing. And that cannot be adequately transmitted through an online product. That can only be adequately, effectively transmitted through our direct contact and communications. What do we need to do to go forward? Oh, no. Okay, go on then.
Can you please go back to the previous slide? Yeah, on the second point, risk transfer solutions play an important role in emerging market growth and development, but the value of insurance is often underappreciated. I fully agree with that. I just want to comment about especially on the government or government-related asset tender, where as an insurance broker, we actually can advise them what is the best cover or the best clause that they can put in the policy, but often that terms and condition already set, they just worry about the price. So the lowest price is the winner. So as a broker, we cannot add value on that. And what I would like to ask is, how do you think in the future it will be like this? You know, when can we broker give a good input to the government entity?
Just an easy one. Thank you for that observation and question. Yes, that is the challenge, right? Which is right now, especially state-owned enterprises, which is, you know, they need insurance. They tend to buy insurance, I mean, the way they buy insurance is purely very procedurally driven, and the procedures are guided by various regulation. Even though those regulation suggests that they are not going to be able to buy the right form of protection, the broker finds it a challenge to say to sort of break that procedural regulation. I think my honest my honest practical view of it is that I relate it to, say, Malaysia, where some years ago we were very much like that, very regimented in terms of how we bought insurance for our state-owned enterprises, being the equivalent of PLN and SKK Migas of Malaysia. But over the years, they've evolved. Now, the reason why Malaysia was able to break away from it and they become more, they take a more commercial, objective view on purchasing insurance, is there is a significant difference between Malaysia and Indonesia, Indonesian state-owned enterprises, and it gets back to the political system. In Malaysia, the SOEs, we call them government-linked companies. The government-linked companies, even though they are government companies, the board of management have total autonomy to operate and make commercial decisions, which is for the benefit of the company. So as a result, say for insurance, we are then able to have that opportunity to say, hey, instead of doing it like this, you must do it like this. And and these recommendations, we can influence them, and they can actually take a view on it and go with it. And that's how we've evolved, because the management are empowered to do that. For the moment in Indonesia, the biggest challenge we have is that it's a very patronage society. Everything leads up to political connections, and everything. So for state-owned enterprises, everything goes up to DPR, whichever DPR committee there is. So in order to get, to get the particular SOE to really listen, it's not it needs to be a parallel approach, not just to the SOE of itself, but to take it to a different platform, to take it to a government platform, and discuss it from a holistic approach, so that you can then start working in it top down. That, for me, is the only way that we can probably try to change mindsets, and because it means, for most of the time, it means changing the regulation. Because right now, most of these decisions where we're not able to achieve what we want to achieve as professional insurance brokers, is because the regulation, prevents. Their excuse is that, well, PKT so and so suggests that we can't do this, etc., etc. But in actual fact, in order, we need to then go take it to a higher level, to explain the concept of risk management, the total cost of risk to the government, etc., etc. And then maybe we can get some degree of inroad to then say, okay, how can we then achieve that? Because well, to me that's probably the only direction. Oh, they're not as good as Aparindo. Oh, no. With a name like Mitba. I think, to be fair, the Brokers Association can only do take it to a certain level. And, you know, we're amongst brokers, we're part of the broking family here. We know that it's really we need to have a strong association in order so that, you know, we can get our points across. And I think we have to be more at one on this. The association is a powerful platform, but, you know, in most countries, the Brokers Association is probably the one with the weakest voice. We just need to evolve through that. And as a comment, as a personal comment to that, I just want to share with you, you know, I've just been privileged to have qualified as a CIIB, myself with Angkatan 17 last year, right? Very proud of that. Now, the point is, we have got several WhatsApp groups as a result of that. I mean, there were, but Wasan, I don't know how many of us, about 50, yeah, around 40 something. You know, I can tell you, it is a very effective platform where we are exchanging ideas. Yes, we're exchanging silly pictures as well, but but you know, we meet regularly. Subgroups meet regularly. We are discussing issues, and these issues we then, you know, kind of it becomes, you know, a specific agenda. I mean, a case in point is, you know, the definition of gross income, declaring gross income against net income, you know, brokerage, where OJK require us to report on gross. Now, that discussion actually started, you know, there was clarity given partially through that grouping. So what I'm saying is that, you know, we all need to talk to each other so that we can become, you know, more at one . Thank you. Oh, sorry. Strong regulatory framework is important, and perhaps our regulatory framework is too strong. A partnership with government and other stakeholders, including insurers themselves. We need to raise awareness through education and outreach programs, because quite frankly, you know, Indonesia is no different than all the other countries. I mean, you know, insurance does not get a fair hearing, and our fees, you know, are subject of massive, you know, negotiating downwards. How come the lawyers don't get into that kind of trouble, right? But then accountants, but we do. So therefore, it's up to us. Sometimes mandatory insurance can support market growth up to a point. So we're all waiting for the third-party liability. We need to build on data collection capabilities to understand. I mean, today it's all about analytics, right? Data information, that's the new oil, you know, or the new gold of the 21st century, right? The more we understand analytics, the more we can understand where we're headed. This knowledge can inform policy and insurance solution designs to sustain the financial stability of households and businesses, and ultimately progress human development. Look to the future now. It's only just begun, and the future's so bright, got to wear shades. Thank you. We can probably pick up questions later after the break.
Oke, teman-teman semua kita break sampai jam 7, nanti balik lagi dan kita bagi nanti kelas. Siap? Oke, silakan istirahat. Bapak-bapak, ibu-ibu, kita kembali ke kelas. Silakan duduk di tempatnya masing-masing. Saya pertama ingin mengingatkan bahwa mata ajar ini nanti kita dikasih tugas untuk membuat paper. Ke masing-masing paper. Ya. Oke, secondly, seperti yang saya sampaikan tadi bahwa kita akan bagi kelompok kita untuk nanti bikin summary, ya, bahwa saya telah membagi, kita ada 49, jadi saya akan bagi dari 1 sampai 5 nomor urut absen itu kelompok 1, kakak nomor 1. 6 sampai 10 kakak nomor 2. Ya. Jadi akan ada berapa banyak tuh? 8 ya. Sekitar 8. Jadi gantian terus gitu ya. Oke, jadi saya usul untuk make free bisa pindah-pindah nih duduknya, jangan kita nyaman di sini saja gitu kan, ya nyaman di sini saja gitu. Ya kita tuker-tukeran supaya kita lebih kenal. Itu important ya, supaya kita lebih kenal semuanya. Yang tadinya jadi jauh-jauh, gue naksir sedikit nih gitu kan. Saya misalnya nih, gue naksir sama Pak Indra nih, kenapa nggak tempelin dikit gitu kan? Sekali itu aja, besok pindah lagi gitu. Oke, jadi sekali lagi 1 sampai 5 itu kelompok nomor 1, 6 sampai 10 kelompok nomor 2, 11 sampai 15 kelompok nomor 3 dan seterusnya sering-sering begitu. Oke. Dan kali ini nggak ada tugas karena ini paper untuk semua, tugas untuk semua. Oke. Paper kalau saya nggak salah 2 minggu setelah ini dikumpulkan. Baik, itu yang penting. Dan sebelum nanti selesai, setelah selesai, jangan lupa untuk kasih penilaian tutor. Oke, saya kira itu, dan silakan pada Pak Ridzuan untuk dilanjut.
Terima kasih Pak Wasan. Okay, the second and final part of the torture. More stats, more charts, more numbers. Reinsurance overview and outlook. We will cover a bit of background, the reinsurance marketplace, financial strength of the reinsurer, how the business of reinsurance works, and future direction of reinsurance. A definition of reinsurance, quite simply, reinsurance is insurance for insurance companies, not just on their own properties, but on the insurance companies' risks themselves. More precisely, it's a transfer of part of the risk that a direct insurer assumes by way of insurance contracts on behalf of an insured to a second insurance carrier, the reinsurer, who has no direct or contractual relationship with the insured. That means, the reinsurer, he has no direct relationship with the original assured. That relationship is through the insurance company only. And simplified view of the link and the chain. Policyholder, which is the client, the original client, pays to the insurer goes to the reinsurer, and the reinsurer, they pass it to other reinsurers, whom we call them retrocessionaires. So you can see sometimes retrocession. There's an expression, retrocession in reinsurance. That's actually reinsuring the reinsurer. Here's another chart of how it all works out. You've got the original clients, across the various classes, and they then go and choose their own insurance companies. And you'll find that we use a lot of different terminology. We use primary insurer for the insurance company. We also use the word cedant for the insurance company. So yeah, we just need to bear in mind they're all the same. So primary insurers take on the various direct contracts, and the primary insurer then passes on portfolios of similar risks or large single risks to the reinsurer, right? So they then go to the reinsurer. Now, in between there might be a reinsurance broker, and clearly it's not just one reinsurer, it'll be many. And the reinsurers themselves retrocede to another reinsurer, right? Or they might go to the capital markets. Sometimes, in the case of, especially in North America, for catastrophe events, there is a strong market for bonds where the capital markets actually finance that risk, and they act as an insurer through financial contracts. And these and it might be that some of these clients go directly to the capital markets. Sometimes they go through an insurer, or sometimes it goes to a reinsurer who then decides to use the capital markets. Just to explain, because reinsurance is all about, or insurance or reinsurance is all about, effective use of capital. Insurance companies or investors say, look, I'm not getting enough returns from the bank. If I just put it in the bank, it will earn me, in certain countries, negative interest or low, very, very low interest rates. So in order to make their money work harder for them, they say, well, look, Mr. Insurance Company, if I give you $100 million, what can you do with it? And then so the insurer said, well, yeah, I can go and write, $500 million worth of risks and hopefully give you a nice return. And that return, be it 3, 4, 5, 6% on that investment, is going to be much better than it being at the bank, in deposits. So that's why the capital markets are happy to receive, to invest in insurance. And sometimes they do that through these raising these bonds. But they only, because they're not in the business of insurance, they are very specific about the perils. They will say, look, here is $1 billion bond or a $500 million bond to protect against winds in the Gulf of Mexico, or to protect against earthquake or hailstorms, etc., etc. So very specific perils where they can reasonably manage their exposures. So why do insurance companies buy reinsurance? These are the 5 major reasons. Capacity allows a reinsured, the cedant or the primary insurer, to write a larger amount of insurance for a single risk. So instead of being able to, I always used to talk about this, in terms of, instead of writing, insuring one house, you can insure 1/10 of one house, and then you can then go for 10 houses and do 1/10 of those 10 houses. So stability, it helps smooth the cedant's overall operating results from year to year. Financing, it eases the strain of the reinsured surplus during rapid premium growth. What that means is that when they've got additional cash as a result of being able to raise premiums, which is pretty much we're headed in that direction now. You know, it eases their strain. Catastrophe protection, which is the most obvious reason why we in Indonesia would buy that, protects against a single catastrophic loss or multiple large losses. I mean, nowadays, you know, I don't know whether you guys are familiar with the expression black swans. A black swan is a rare animal, right? Hardly ever see, I mean, you see white swans, but you hardly ever see black swans. So it's a rare event, a black swan event. Nowadays, maybe because we never calculated it rightly, there are more black swan events around than there are than we kind of previously provisioned for. So, you know, catastrophe protection is key there. Expertise and services. Provides the insurance company with a source of underwriting information when entertaining new lines of insurance or new market. I mean, when we talk about the new products that are being discussed today, as an example, you know, the most fashionable product is cyber crime right now, cyber insurance. It's driven by the reinsurers. They are the ones who develop the pricing model for it. They are the ones who develop what shall be the underwriting parameters for the insurance company to be able to sell that product. So in them doing so, the insurance company then gets the benefit of the expertise and services of the reinsurer, because they're in a well-positioned place to develop these products and come to these formulative ideas. You know, one of the things I didn't mention in the other presentation was that in that CII report about you know, customers, SMEs, and all that, one of the biggest problems the SME buyers of insurance complained about was that the insurance industry is full of jargon. It's you know, it uses words that nobody else understands in normal English, and we still, you know, like, just within the first couple of slides, we talk about retrocession, we talk about cedant, you know, and all these other words. You know, there are far simpler ways of describing it. So here, to confuse everybody even more, we tell people, oh, we do proportional and non-proportional business. So, you know, the best way to describe it is this chart. Proportional insurance, reinsurance, is basically, it's in proportion. There is a you know, relevancy between the percentage that the reinsurer retains, and it's pari passu all the way up. You know, there is no distinction. So therefore, if he takes 25% of the risk, he's got 25%. That's 25% all the way up to the actual ultimate loss, right? Whereas for a non-proportional, the reinsurer will sit somewhere in a different level, in a different layer. So, say if this was a tower of $100 million, this is probably up to $60 million. You'll see it in the next slide. The reinsurer says, well, I'll only take the losses, you know, in excess of 60, you know, and up to 80. Beyond that, you pay yourselves again. So when you have those kinds of contracts, it's non-proportional because it is what it is, not proportional. So the gray is the insurer's retention, and the yellow will be what the reinsurer picks up on a proportional basis and on a non-proportional basis. The difference between pro rata, you know, proportional, and excess of loss. Facultative. See, then we bring in new buzzwords. You know, fac and treaty. Facultative is reinsurance is when you're insuring each risk one by one, whereas in a treaty, it's a portfolio of risks. And they can be written on a pro rata or excess of loss basis. On a proportional basis, reinsurance agreement which a reinsurer shares the same proportion of the premium and losses the same losses of the ceding company can either be quota share or surplus share. Surplus share is where quota share, is a clear definition of certain percentage of the risk, whereas a surplus, just to make it more interesting, they do something called lines. So therefore, surplus 30-line surplus treaty. So each line is say $10,000. So 30 lines is $300,000, and that's how they define the split of the risk. Advantages: good protection against frequency and severity potential. Recovery is pretty much first dollar basis, and you can collect on practically every loss that you have. If you're buying proportional, most likely you can claim of it. But what it means is that if you claim of it, that means the cost of a proportional reinsurance is higher. So therefore, you're giving away more of the basic premium money away. So instead of retaining, say, 40% of the risk premium, you're only retaining 20% of the risk premium, because much of the other risk premium has to go towards paying for proportional reinsurance premiums. On non-proportional excessive loss, reinsurance agreements that indemnifies a ceding company against the amount of loss in excess of a specified retention. So you saw that in that tower, there was that tower, and then there was the yellow block sitting on top. Okay, that's the amount was in excess of that. It sits just on top of everything else. Good protection against frequency, severity potential, depending on the size of retention. You retain more of the ceded premium. So therefore, that particular example I was giving, if the insurer was having to pay 40% of the risk premium for insurance to the reinsurers, it will be much less if they were doing it on an excessive loss basis. So and it's also more economical in terms of cost and administration. So this is how the pro rata looks like in another form. So they have exactly the same. Like if they retain 75%, they then the reinsurance company takes 25% of the premium. They keep 75. And when it comes to losses, it's exactly the same ratio. They pay 75% of the loss, and 25% is sorry, I was probably saying it the other way around, but it's 75-25. Whereas for excessive loss, non-proportional, it's slightly different. Here you got a say you got a 40 million retention. I mean here, okay, the elements of excessive loss requires the insurer to retain a specific dollar amount of risk. Reinsurers accepts the risk in excess of that particular value, and the premiums and losses are not shared proportionately. So say with this $100 million, right, if the premium was 1 million, right, on a quota share basis, if the reinsurer says, okay, I'll give you a 25% quota share, that means that reinsurer will demand 20% of that $1 million premium. And the sharing is then prorated. Whereas on this one, the insurer says, I will take the first 40 million. Anything that happens up to 40 million, it's for my account. I will pay for it. No need to buy reinsurance protection for it. But once it goes into more than $40 million, $1 more, like 40 million and $1 up to $60 million, that one, the reinsurer takes it. And the premium, the basis of premium for this $60 million protection is much lower. It's a much smaller percentage of the overall $1 million original premium, because most of the exposure is expected to be within that first 40 million. So that's how it generally works. Difference between reinsurance and excess insurance, because there's also excess of loss, but excess of loss is a reinsurance, but this is excess insurance. Reinsurance, the primary insurance company writes the full amount and cedes a portion of the limit above the attachment point. The reinsurance contract follows the form. That means full clause of the underlying primary policy. And the insurer assumes a credit risk if the reinsurer is unable to fulfill its contractual obligations. Right? That's a reinsurance contract. Whereas an excess insurance, the excess carrier writes a separate standalone direct contract that covers the losses above that primary carrier's own retention. Excess carriers could have different coverage terms and conditions from the primary policy, and the primary carrier is not responsible for losses above its retention if the reinsurer is unable to fulfill its obligations. So, give you an example. When there was a recent withdrawal of the market from a major regional reinsurer, Asia Capital Re, ACR decided that they were they were not going to write any more new business, and they were going to go into runoff. And what then happened was the insurance companies who have risks that are reinsured with Asia Capital Re now find, like, okay, just to backtrack, and because they did that, Asia Capital Re did that, Asia Capital Re lost their rating, so they were no longer A-. As soon as they were no longer A-, it meant that for some Indonesian insurance companies with big projects that are, where lenders require them to arrange insurance, and all reinsurances must be with A-, minimum A- companies, the Indonesian insurance companies who had reinsured with ACR suddenly found that they had to replace the ACR line. Now, the thing is, they had to replace the ACR line at their own cost, because this was not an excess policy. This is, this is a reinsurance policy. So, primary carrier assumes a credit risk. So, some of our major insurance companies in Indonesia actually ended up having to pay extra premium, like halfway into the contract, just to allow new markets to come in for the final 6 months or whatever, so that they can comply with the lender's requirements. So that's how the reinsurance works, i.e. the exposure for primary carrier to carry the credit risk. Whereas if you look at the previous, this slide, if it was written on a pure excess basis, right? Okay, this is excess of loss, right? It's all one thing. But if it was just ACR wrote a policy that says, I'm going to issue you a policy, issue a client a policy of 60 million, excess of 40 million to the original client. Okay. Under those conditions, when ACR lost their rating, right? These guys who did the 40 million saying that's got nothing to do with me, because I'm only writing my 40 million. I've got nothing to do with the excess of 40. So there's a subtle difference there. Basis of reinsurance. This is the common one, risks attaching basis. It's for claims incurred during the from the policies commencing or renewing during the period of the contract. Losses occurring basis for all claims incurred during the reinsurance contract, irrespective of when the policy incepted. So the policy could have actually incepted before the reinsurance contract. So therefore, the reinsurance contract was placed in 2019, 1 Jan 2019. It could have picked up losses in where the policy incepted in 2018. Claims paid basis for all claims paid during the reinsurance contract, irrespective of when the attachment point is. So if you've got a claim, submit a claim. That's it. They pay during that policy. This is obviously now, nobody gets that now. But in the U.S., I mean, like all good things, all the problems come out of the U.S. This was a major issue for the U.S. markets, because they wrote the international reinsurance markets wrote a lot of North American business and was on claims made basis. And what then happened, I mean, the most famous case was when the Lloyd's market had to respond to asbestosis claims that were kind of first incurred. The incidents first incurred 15, 20 years earlier, but there it was in the 1970s, 60s and 70s. They were having to pay for these claims. So that was the North America, the U.S. Kind of environment then. So when you hear about, like in history, insurance history, asbestos claims and all this, it's actually because of that, because it takes such a long time to materialize. Whereas nowadays there's no way that you're going to get a claims made basis. Any claims experts here want to make comments? Yes.
Thank you, Pak Ridzuan. The slide is talking about the premium and the claims paid. I just wondering, how about the recovery from the insurance company that can get the money from the subrogation?
Right.
Is there any forms of reinsurance agreement which can also be dealt in front before they are doing the business with the reinsurer, or any retroactive insurance or anything? But thank you.
Thank you. The question is whether there is any easy way to trigger subrogation benefits for the insurance company. The current answer is no. Purely and simply because subrogation, only works once liability is established and the fault is then identified and allocated to that particular either insurance company or there's a direct recovery. So there is no mechanism right now that I'm aware of that you can put in place where you can automatically benefit from that. So talking about benefiting from all of that, how does reinsurance benefit its clients? And its clients are insurance companies, right? Because the insurance companies' clients are the ultimate customers. Well, we look at three areas: risk transfer, risk finance, and information. When it comes to risk transfer, the reinsurers, as we said earlier, they stabilize the financial results by smoothing the impact of unexpected major losses and peak risks. That means they take out, they protect the insurance company's balance sheets by taking out the shock losses, the unpredictable. If there was a second swan, black swan happening. I mean, talking about black swans, I mean, we, you know, similar to black swans, we also describe events as 1 in 40 years, 1 in 100 years, 1 in 250 years. And all these events, where you know, they're all natural catastrophe events. They're all, you know, we've made these calculations based on, you know, historical data, and we're now finding that that historical data may not be as accurate. Hence, when you get 2 black swans in 1 year, you can get 2 or 3 1 in 40-year losses in 40 years, and certainly we are seeing more than 1 claim for you know, 1 in 100-year claim. We're seeing it being hit more than once. So some of these analytics are not right. So that's where, if you've got that's where reinsurance protects the insurance company, because you can predict for 1 catastrophe, but, you know, can you predict for 2 or 3? Well, you can't. You can, you know, then you'll never do any business. So you can assume that it's safe to only have 1. But with reinsurance, if the second or third event happens, and if you're adequately reinsured, you won't be affected. So that's the benefit of reinsurance for the companies. So the companies become more attractive investment proposition and benefit from their own reduced cost of capital. They don't have to reserve so much of their capital to anticipate for losses. Risk finance. Reinsurers offer reinsurance as a cost-effective substitute for equity or debt, allowing clients to take advantage of global diversification. The benefit for the client: capital is freed up, thereby increasing underwriting capacity and enabling growth. If insurance companies did not have access to reinsurance, they can only write up to what, 7 or 8, to be prudent, 7 or 8 times the amount of capital that they have. That's about it. If they're going to write more, then they run the risk of heading towards insolvency. Information supports clients in pricing and managing new products. We mentioned that earlier, and expanding their geographical footprint. This allows the insurance company to accelerate profitable growth. So you can see that, you know, reinsurance is there. It's you know, it's symbiotic. I mean, they go hand in hand. It's just another, you know, the other side of the coin, of the same coin, delivering the same function, which is protection. But what does it do? How does reinsurance benefits society at large? Which means, you know, the insurance company's customers. You know, why would reinsurance be relevant to them? You know, what effect does it have on them? Because they only pay premiums to insurance companies. Looking at the same 3 definitions: risk transfer, risk finance, and information. When it comes to risk transfer, reinsurers diversify risks on a global basis. Benefits for the society: makes insurance more broadly available and affordable, and enables economic growth. I mean, without this, right, for the society, in Indonesia, when we look at the society, we can look at all the major businesses, you know, whether it's Garuda or SKK Migas or PLN or Krakatau Steel. These are all state-owned companies. All the IPPs, you know, the Indonesian insurance markets will not be able to absorb these risks by themselves. They have to, you know, because their capacity, when I say that, their financial capacity to absorb this risk is just too small. So that is why with reinsurance, they're able to participate in a bigger percentage. That means bigger percentage means that they can have a bigger chunk of the premium and work that premium money to turn it into a profit. So not possible without reinsurance. Risk finance, capital market functions, invest premium income according to expected payout, provides long-term capital to the economy on a continuous basis. I mean, the reinsurance markets is handling significant billions of dollars which are invested into the global economy. So, you know, it is an integral part of the financial services system. Information puts a price tag on risks. As we said before, right? New products, how do you price it? Well, the reinsurance companies do that. They pass it on. So there's a price for the risk, and how does it benefit society? You know, I like this. It's a cute way of saying it. But it's benefit to society. Incentivizes risk-adequate behavior. What that means is that you don't want to put sprinkler. We're going to charge you more, lah. Right? So, but what it does is it forces industry to become more risk aware, and that, so you can see the connection there. Bit of history. The origins of reinsurance. It's amazing how people can keep records. I mean, the first recorded reinsurance contract was signed. I mean, they figured it out. It was the 12th of July of the year 1370. I mean, you know, don't quite know how they thought it was, you know, to keep a document for so long. Mr. Grillo contracted with two gentlemen, Mr. Benaira and Mr. Sacco, to reinsure a part of a ship's voyage from Genoa in Italy, which is then to go all the way here, right across here to somewhere near Bruges in Belgium. And around about this area here is extremely hazardous and very prone to shipwrecks. So Mr. Grillo thought, oh, great, I've got this piece of business, but I don't want to expose my money to the most hazardous element of the journey. So then he talks to Mr. Benaira and Mr. Sacco and say, look, would you guys like to take on this just for this few moments, you know, this hairy part, you know, you take that bit on, lah. And then after that, pass it back to me, right? And then for a price. So if you charge $100 to the original buyer of that insurance contract, right? Mr. Grillo then probably negotiated with Mr. Benaira and Mr. Sacco, you take $30 lah, right, for that part. So his profit on that, it'd be based on 70 rather than 30. But then, you know, he knows, he's assured that if there was the biggest area of exposure was that bit, he's reinsured it for $30. So that was the concept, that still is the concept of insurance. And if you look at proportional, non-proportional, where the underwriters sit, you can see it's the same concept. So that was the first contract. And I'm reminded of this particular thing of taking out the hazardous bit. I'm reminded of I'm old enough to remember this. There was a Lloyd's underwriter. His name was Ian Posgate. And Ian Posgate, he was an extremely clever man. He was basically a marine underwriter. He was good at numbers. I mean, he can calculate anything, you know, to any extent. He was a double first in mathematics from Oxford. I mean, that's how clever he was. But he was a maverick underwriter. I mean, he used to take risks. I mean, this is the good old days when, you know, you don't bother with engineering reports and all the actuarial studies and all this. Like, you just whack in a deal and say, hey, how much, huh? So anyway, Mr. Posgate, his nickname was Goldfinger from the James Bond movie Goldfinger, because everything he touches makes money. So Goldfinger, what he used to do was in the 1970s, right, there was a series of there was a terrorist group called Black September, which was basically the Palestine Liberation Organization's terrorist faction, and they used to go out hijacking aeroplanes just to make their point known. So they'd hijack airplanes, and they, most of the time, not all the time, would blow up the airplane. You know, they'll release the passengers, and then they'll just blow up the plane. So what Goldfinger did was, being very clever and thinking like how Mr. Grillo used to think, anytime there was a hijacking, right, he would ask the other underwriters whom he knew was writing that particular aircraft, that's sitting on the tarmac at Beirut airport, and he will go up to the underwriter and say, "Hey, James, I know that you've got a 5% line on that TWA jet sitting on the tarmac in Beirut, which is now the subject of a hijack. And the hijackers have threatened to blow up the aeroplane within the next 12 hours if the ransom's not paid or the prisoners are not released." So yes, I'm very worried about that. Because not only does he have to pay, but it would cost his reinsurance a lot of money. Because what would happen is that next year he would pay a higher price for his reinsurance, which he will then have to pass on to the customer. So in order to keep his reinsurance contract clean, Mr. Posgate, aka Goldfinger, would say, "I will reinsure you for the next 12 hours of this risk, right? But it's going to cost you £10,000, right? Whatever it was." And Goldfinger made a lot of money by being opportunistic, doing that on aircraft hijacking. He also did that on sinking vessels. The coast of the Gulf of the Cadiz coast. That's a very prone to shipwrecks. Along here also prone to shipwrecks, and here. Well, he did the same to marine underwriters with vessels that were kind of like, damaged. They hadn't quite sunk yet, and you say, "Okay, you don't know whether you're going to be a total loss or not, but I'll do it for the next 3 hours for so much to take it out." So that was Mr. Goldfinger. He was so clever. Unfortunately, he became too clever, and he became non-compliant, and I think he did some jail time. But that's another story. But no, but it shows you in those days it was more enterprising, but it shows you how reinsurance works. You take out that potential of where you think the losses are going to be, whether it's a single loss or a series of losses, or the English expression, either you die by one sword blade, or you die by the death of 1,000 cuts. So yeah, that was Mr. Goldfinger. The origins of reinsurance really started anytime there was a big fire, they formed a new reinsurance company. This was in the days of during the 18th century, the Industrial Revolution in Europe saw the creation of many insurance companies, and some of them are still here today. The first professional independent professional reinsurer was Cologne Re, which is no longer there because I think now it's part of an American reinsurance group. So here, 1842, big fire in Hamburg, Cologne Re was set up. In 1863, big fire in Glarus in Switzerland, Swiss Re was set up. In London in 1861, London had so many big fires, but this particular big one in the later years, 1861, led to the formation of Royal Sun Alliance. And the reason why there were big fires during the 19th century in what was then modern Europe because this is where the center of business and commerce was, purely and simply because all the buildings were wooden, and so the exposures were very high. Okay, there are about 200 companies offering reinsurance. Just to add to the confusion, actually there's more than 200 offering reinsurance, but what they're saying here is that there are 200 professional reinsurance companies, companies that only do reinsurance. They don't do direct business, or they don't dabble in anything other than pure reinsurance, so they're called professional reinsurers. So there's about 200 of them. The top 10 non-life reinsurance reinsurers by premium volume account for, like most things in life, account for half the total global premium volume, whilst the top 10 of the life reinsurers account for 2/3 of global premium. Germany, USA, and Switzerland are the 3 most important domiciles for reinsurance companies, mainly because historically that's where the businesses were developed. But following clever accounting and all that, key players can now be found in Bermuda and other places, Labuan. Beyond this circle, this is where I was saying, beyond this circle, there's a large number of primary insurance companies who also write reinsurance business. So as an example, we all know Allianz is a big domestic insurer here in Indonesia and around the world. But at the same time, Allianz is also big in reinsurance. They have different trade names on it, but basically Allianz also are very actively engaged in the business of reinsurance, mostly facultative reinsurance. They don't tend to do treaties. Most of the insurance companies that do reinsurance, other than the professional reinsurance companies, they don't tend to get involved too much in treaty business. So there's about an annual premium income of about 200 billion, and roughly half of all reinsurance businesses come from North America, not surprisingly, like what I'd mentioned earlier. This reflects the huge size of the market, as well as North America's exposure to natural catastrophe liability risks. So the international markets is centered around the London market. The London market is highly dependent on North American business. Without that North American business, the London market would be much smaller, a much smaller marketplace. Here we see the size and structure of the reinsurance markets. As you can see, the biggest chunk here is USA, Canada, and then advanced Europe, Middle East, and Africa. And then we got China. China really is going to be a major player. And then we got the emerging markets. Sorry, you got the advanced Asia markets. These advanced Asian markets are basically Singapore, Taiwan. And then you've got emerging Asia excluding China. That's us. And then you got all the other countries. So you can see, that where the premiums go on a global basis. Actually, in my previous presentation, I got 50 of these companies, but I decided only to put 20 of them up. This is hence I didn't correct the top 50 global reinsurance. It's now the top 20. It's always, between Munich Re and Swiss Re, they're always there. Either one of them, wake up one morning to be the number one. If they're not the number one today, they'll be the number one tomorrow. It's a bit like Marsh, Aon, Willis. They're always the top three in any order. at any one time. But you can see, you know, the countries where they're based, right? I mean, you've got your traditional ones, and then you've got American companies. Korean Re is now a phenomenal reinsurance player. GIC India, another very strong player. And you know, not many people would have heard of MapFree. MapFree is a Spanish company, but they're a major player. And Toa is the first of the Japanese. Oh, no. Mitsui is there. Yeah, because I was going to say Toa is fairly limited, but that's where it is. But one thing I'd like you to appreciate, right? Is here you can see the premium volumes split between non-life and life, right? Then you see the loss ratios. The loss ratios are all fairly consistent, but look, this is what I want you to see. The combined ratios, right? The combined ratio is the profitability of the insurance company, right, against claims plus expenses versus premium. And you can see this was 2018 ranking, which means it's 2017 numbers really. It may, no, actually, yeah, 2017 numbers. But you can see, you know, out of the top 20, how many of them are, you know, they've got combined ratio in excess of 100%, i.e. they're not making money. So this was the trend as of, you know, in the end of 2018, which is where these numbers came from, based on 2017 numbers. But you can see these reds, and I had done an earlier, in earlier presentations, I picked up the earlier results, and I can tell you that there were more reds along the top 20. So reinsurers were struggling to get to make healthy profits. And I just want you to, you know, to appreciate, as a reinsurer, you're producing losses, but you've got to maintain your income, because if you don't get the income, how are you going to pay the claims? How are you even going to grow, right? But if you keep making losses, you know, it's a vicious cycle. And so what's happened is in recent years, you know, as I said earlier, the investors are saying, okay, all right, Mr. Underwriters, you are costing us, you know, 100, you know, like 115%, you know, in terms of combined ratio. I'm going to give you $100 million. Make full use of this, but look after it. So in order to look after it, they then have to be very disciplined in underwriting. They have to be very strict about the terms and conditions and about the pricing. But if you are very strict about the terms and conditions and the pricing, all the broker's going to do is say, "Allah, you too expensive, lah. Go to somebody cheaper, lah." So this reinsurer says, "Hey, if I don't get that business, I'm going to have even bigger problems because I'm going to have a lower income." So this is the kind of balancing act that the reinsurance market was undergoing, and now there are signs that they're beginning to stabilize, but we'll see how long. Unfortunately, underwriters have a very short memory span. So drivers of business conditions for reinsurers. Past several years, reinsurance sector has weathered unfavorable and continuously changing business conditions. So the issues that they faced, you know, the soft reinsurance pricing cycle. You know, another element, you know, like I spent a lot of time doing energy reinsurance. Just to share with you, you know, how, you know, what was happening with the energy reinsurance market. In the last 5 years, the total energy reinsurance premium has halved, right? So if it was, say, $1 billion total from every single energy insurance risk 5 years earlier, today it's only $500 million. But the values, right, have doubled. So therefore, you know, why for the investors they're saying, why are you writing energy reinsurance, right? You're losing money. The margins are low. If there is a margin, most of the time it's going to be a loss. You better pull out of energy and do liability. But liability cannot hit the premium volume. So these are the issues that reinsurers face. Heightened competition. I mean, here, their competition is not just from Swiss Re, Munich Re, to Korean Re, to GIC. Their competition is also the capital markets. What I was telling you about earlier in the earlier slides about the bond market. These bankers are coming in and say, yeah, we'll take that risk. We'll do it cheaper than what you would do for conventional reinsurance. Limited growth for limited organic growth opportunities. There are not too many for us as brokers. We can either grow organically, i.e. go out and get more business, right? And if we have enough funds, invest in buying another insurance broking company, so that it's inorganic growth. So you buy something else, and then therefore you got a big volume going forward. So with reinsurers, there is no opportunities for organic growth. I mean, like they talk about movements within 5% is a big risk. Is a big jump. I was talking about alternative capital, low interest rates, mergers and acquisitions, which creates competition, and large catastrophic losses. I mean, these large catastrophic losses, I'll talk to you about it in a minute. They have really made a severe impact on the industry. Against this backdrop, reinsurers are trying to pull whatever levers they can, not only to remain relevant, but also to sustain profitability. Again, imagine that discussion that the CEO of the reinsurance company has with his shareholders to say, you give us so low returns now, and now you're telling me for the next 6 months, it's going to be really tough, and why would we continue to support you? Because remember, North American companies, they are beholden to their shareholders, and so it's all about shareholder value and the share price, and it's all about growth. And if you can't get growth, CEO loses his job. Two charts which look better on your documents, which basically one is the profitability of property and casualty business in 2018. The range is not very exciting. It may peak with certain in earlier years towards in excess of 10%, but over the last several years, it's been below 10, and it's only slowly creeping up. For the life markets, which are managing huge funds, the low interest rates is dampening the profitability. China will continue to be the key driver in the global reinsurance market. You look at this table here, right? 1980, 2018 estimate, and prediction of forecast of what it would look like in 2029, right? In 1980, the US was like almost half, 42% of the global market share, and China was nowhere. Right. Now you fast forward to 2018, the US share of the global market is only 28%. They've been significantly affected, and lo and behold, China comes in at double-digit, 11% share of the market, and Japan, from 16, they're now half of what they were before, which is why their economy is really stagnant. UK has been pretty much consistent. right? But the real story here is China. So the projections for 2029 is the US will probably stabilize because their economy is still growing, but will still stabilize at 25%. But China will be 20% within striking distance of the US market share. And everything about reinsurance now is all about emerging countries and China, right? And Indonesia is part of that emerging country equation. Okay, they do pay for losses. Here you can see there are more uninsured losses than there are insured losses, right? The dark brown is the insured losses, and then the lighter blue are the uninsured losses. So you can see it's there is a huge gap. The other element to this is that natural catastrophes are now increasing at a worrying pace. And yeah, here you can see it. I mean, like, due to climate, geophysical, etc. (2017) blaming it all on him. I thought I'd spend a few more minutes on this. How events the other side of the world affect reinsurance pricing in Asia. You know, a couple of years ago, well, you know, all throughout last year and the year before, right? The Asian markets, including Indonesian companies, were being told, "Oh, no, you can't have a reduction." Why? Oh, because of him. Oh, who's him? Harvey, Irma, and Maria, the three winds. Okay, so they said, "Well, what are North Atlantic wind damage got to do with us sitting in Asia?" Right? Well, it has everything to do with us in Asia. There is a contagion effect on it. So, to show you the potential powerful impact in terms of what natural catastrophes can cost and the consequences of those natural of those huge losses. The top 5 costliest hurricanes on record. Katrina still stands at the top, $161 billion. Then got Harvey, Maria, and Irma there. And then there was Sandy. So there's only Katrina and Sandy being the older winds that cost, significant monies. But Harvey, Maria, and Irma, 3 black swans. Well, I mean, probably 2 of them were black swans. One of them was kind of predicted. Look at the numbers. I mean, they could have reached catastrophic results. I mean, it already is catastrophic, but it could have been much worse. And that was why at that time when Harvey, Irma, and Maria happened, reinsurers tried their very best to push up rates and get back to underwriting disciplines. But thanks to effective good brokers, they were not able to carry it out, and 6 months later things were back to normal. But it could have been so very different. Talking about the black swan thing, right? This is a chart. Oh. Time flies when you're having fun. Okay, this is a chart that basically says the reinsurers they need to predict the rate of return on significant losses. And I was talking to you about the 1 in 10, 1 in 60, 1 in 40. How quickly can they recover? You will see that this, according to this chart, they don't. They have problems recovering. I'm nearly the end anyway. So This is my take on emerging risk themes. Okay. All the big brokers talk about cybercrime and all that, but the exposures are there. The exposures are real. As to whether we can monetize it in Indonesia effectively, don't know. But you know, cybercrime is real, especially in the financial services sector, even in Indonesia. Population growth, putting stress on local resources. We're all living longer. That means we're getting, you know, like it's costing more money. Energy security. We got coal issues, oil issues, water problems, air pollution, food security, social unrest. I mean, we're seeing all this now, and of course, pandemic. I mean, we're seeing all of these risk themes happening right now. So it's there's no brainer, and you know, it's how we, you know, whether there's enough funds to manage all of this in the West, because it eventually comes down to us by way of higher reinsurance premiums, which means higher property rates. Oh, there was these slides. These slides tell you how the insurance companies, reinsurance companies, run their business. I mean, it's a very difficult job to sorry. God, even the clicker wants to end it. Reinsurance companies are solid. They can't fail. I mean, in terms of they need to be strong, but they can't fail because the way they operate, and that those notes tell you how they are strong and how they manage it. Right. Sorry, I went over. I forgot to look at the time. Thank you.